That's right, guys. In this video, we're going to talk about why shorting sucks, especially when you don't know how it works. What do I mean by that? Well, let me show you behind me. We have a nice diagram that I've prepared for you with all the risks of shorting and also all the risks of going long, and also how professionals use shorting and if they are successful with it, and also mitigation strategies, basically the solution to all of these problems. And with all of that information, you will finally understand why shorting, well, sucks, especially when you don't know how it actually works in the background, okay? Because a lot of you guys come to the Telegram group and say, hey, can you add shorting because it's just the opposite of longing? And like, no, okay? It's not the opposite, mate. You need to understand why I'm saying that, okay? Which is why you need to watch this video until the end to fully understand the game. And once you understand the game and you understand the rules and the risks, you can play the game. It's okay, right? But you need to first fully understand. And I have the feeling that a lot of people, they just want to short because the market is going down. Yeah, makes sense. But do you know what you're getting into, right? Do you know the probabilities? Do you know how it actually works? The costs, right? Do you know the costs of that? I will tell you all of that in this video. And instead of explaining this 50 million times, at least that's how it feels for me in the Telegram group. By the way, link to the Telegram group down below. We are a huge amount of people. I think we're about 15,000 people or something like that. I will put it down here as a number later on. And we all care about algorithmic trading, trading strategies, risk management, automation, by the way, is very cool. Part of the whole thing is automation, right? To automate your trading strategies. But instead of explaining it all the time, I want to make a video to cover the topic, okay? So this is the video. So every time somebody asks about, hey, why not shorting? Or hey, shorting is easy and blah, watch the video and then let's talk afterwards, because then we are on the same level, right? You know what I know, and then we can go and talk about it, right? Having said all of that, as always, this is not financial advice. Crypto is risky. You can lose all of your money, especially when you go short and you leverage. More on that in this video, okay? And because of that, you subscribe to this channel, you like the video, you click the bell, you click on all because you want to get all of the information, the educative information on this freaking channel, because every video increases your chances of success. Okay, with all of that in mind, let's get started, guys. And for the ones who actually stay until the end of the video, I will have a big surprise for you. And you will be surprised that I have that surprise. So you will see what I mean once you get there. Have fun with the video. Okay, guys. First of all, let's remember how shorting works. Very briefly, you have to understand this, right? So first of all, you have a downtrend. Awesome, right? And that means that you can go short. Of course, you don't know exactly what will happen, but let's just go with this. Let's say you go short here, right? And then you buy back here and you profit the difference between this and this time that you have sold it more expensive, right? You borrowed it actually here. You borrowed it from somebody, usually the exchange, right? Let's put here exchange, right? You borrowed it from the exchange. You pay some fees. Keep that in mind for later. And then you buy it back cheaper, right? And you give it back to the exchange and you get to keep the difference minus the fees. All right, cool. So that is basically how it works. So it is betting that the price goes down, but you have to borrow the asset to sell it and buy it back and then return it to the exchange. So that is a big difference, which we're going to talk about more later on. Now, the main question is, most people that are shorting, are they profitable or not profitable? If you look at the stock market, right, then you have to actually check this chart over here. It's called the short bias index, and it shows basically if people that go short, if they were profitable or not overall, right? So you can see most of the time they lost money. Actually, since 2008, they continued to lose money. And 2008 was the financial crisis, and it seems that they kind of predicted it very nicely because they started shorting somewhere between here and here, right? And they made money. And after that, they still shorted, but it was the wrong move, no? Because the market went to the upside. And well, this is not awesome, right? Because this actually shows you that if most stock traders are losing money when shorting, then what makes you and me different? How can we do better, right? Can we do better? Keep that in mind as a question, because whenever you see data like this, then you automatically know that the odds are not in your favor. And that's not great when you're placing money to make money, right? You want to have the best odds, all right? So keep this in mind. This is not a fun chart. These are 17 years of short sellers losing money, okay? Most of the time. So this is crazy. Now, going to the next piece of evidence, in the crypto market, 90% of retail investors lose money when shorting, okay? This is less reliable data because it's crypto, right? But still, it kind of makes sense, right, when looking at this. The next piece of evidence or information simply that you need to know is that the fees for shorting are pretty high, especially the longer your short is going, right? Like if you keep it open for a long time, then the fees will eat up into your profits or into your funds, right? So this guy says basically the fees could reduce potential earnings up to 15%, which just makes sense, right? I mean, if you're an exchange, then why wouldn't you take high fees for borrowing money? Because you can, right? And people are greedy and they want to short, like, and that's what they do, right? Especially in crypto, the fees are pretty high, okay, for borrowing funds to short. We're going to talk about this a bit more. And then on top of all of that, you have this, but I want to show you this in combination with the risks, okay? So let's start with revealing this, these curtains here, right? And talking about the risks on both sides, right? And in this particular case, I want to talk about going long and short with 1x, meaning that we're not trying to borrow more than we have, right? Okay, right? So 1x, right? So this will be important. That's very important, actually. So let's start with the risks of going long, okay, on a spot market, right? So let's reveal this freaking thing. Let's delete it. So prices can go against you. Wow. Yeah, great. This is a big revelation because obviously, and on the short side is exactly the same, right? So those two risks exist on both sides. I mean, this is obvious, right? But let's talk about the price going against you when it comes to shorting compared to when it comes to going long, because that's a huge difference, okay? So let's talk about the price going against you in the short scenario, okay? So in that scenario, let's say, right, that you're placing a short that is not optimal, right? So let's say you're shorting over here because this was a really ugly time and everyone thought Bitcoin is going to, I don't know, 5,000 or something. And because you place a short at 1x, right, you have some liquidation level, right? So the price has to go to some level so that you get liquidated, right? So let's say it's here just for argument's sake, right? And so the price goes there and is very close to there. So in order for you to avoid getting liquidated, losing all of your account, basically all of your funds on the account, you have to add more money into that short position. So you move the liquidation level further away from you because you don't want to lose all the money, right? So then the price comes close again, right? You need to add more money. And you move you don't even know where exactly, right? You move it here because this is the high, you move it a little bit above the high, and then the price comes closer, then you have to move it further, right? You put more money, and then finally, you basically come back to break even, right? But you always had to pay all the fees during the whole time. Okay, like the exchange never loses money, right? So don't think that they lose something. And so at some point, if you keep it open for long enough, you can then sell it or buy it back actually here to make this difference in profit, okay? You make some money, right? The problem is though, that this was a very long time, okay? So let me go to the chart quickly. And on the chart, it was roughly from here to here, right? So we're talking about 312 days, which is almost a year of you keeping that short open. And that is not great because that will eat into your profits because of the fees, right? You have to pay the fees which are ticking every hour, which I'm going to talk to you more about in this video. So, okay, like keep that in mind. We're going to talk about more about this, but this is important, right? So this is one of the risks that you do not have if you're going long, because if you're going long and the price goes against you, so let's say you go long here, 1x, yes? I'm not talking about leverage whatsoever, okay? You go long and it goes against you. You have no costs. It doesn't cost you anything to keep this open. Yes, you lose money on paper and you do lose money, right? If you sell here. But at some point, right, when it recovers, even if it takes a year, right? Now you're in profit and you didn't have to pay any kind of fees to keep this going, right? Because you're on the spot account and it's easy. I mean, there is no borrowing, there is nothing, right? You don't owe people anything, right? So that is ultra important to understand, that this is a huge difference between the price going against you when shorting versus the price going against you when longing. Because on the short side, you can actually lose all your account because you get liquidated, okay? And you owe money for the fees. And on the long side, that's not the case. That is why I'm saying that simply going short is not the opposite of going long. I mean, in theory, yes, but on paper, the risks are massive. okay? It's not the same. It's not just the opposite, right? It's very risky if you don't know how the game is played. Okay, so this is very important to understand. The next thing that you need to know is that, well, you have more fees. We already talked about that, but I want to show you those fees. Actually, let me click on this. And this is from Bybit. And this shows you for every asset that you borrow, the hourly borrow rate. Okay, so you take this percentage and every hour on the borrowed amount, right? So it's not cumulative, right? It's only on the borrowed amount. Every hour this will tick up and it can get pretty expensive over time, right? So I leave that to you to calculate, but just keep in mind that those fees are there, okay? And on top of that, you can go back here to what I told you before. They can actually add up quite dramatically. And even if you make profits, you lose 15% of that because you have to give it to the exchange for the fees that you had to pay, right? So that basically means that if you are going short, then you have to be not only right, you have to be more right than when you're longing, because you need to pay the exchange more money, right? So you need to make way more money, way more profit when shorting than when longing, because you need to cover all the fees as well. So that adds another risk, okay? So the next thing that you need to know, the next curtain here that we want to remove, is that you can have unlimited losses, okay? And basically you already know that, but because I showed you before, but let me explain, right? So let's say you go short over here, okay? And this is super bad time, but still. And then you have the liquidation level somewhere here. And because it gets close, you have to add more money. Remember, right? You add more money, and then 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 you add more money, right? So that is why your losses can be infinite, because the asset can go up to an infinite number. There is no limit to the upside, but there is a limit to the downside, okay? So if I go long, I can lose 100% of my funds. Pretty bad, but I cannot lose more, okay? But if you go short, you can actually lose more because you constantly have to add more money to keep your position open, right? Or unless you get liquidated, then anyway, you lose the whole account, right? But this is something that you must understand. Actually, let me do it like this. Because if you don't understand this, then you don't know that you're taking this additional risk, okay? So to the upside, you can lose infinite. To the downside, you can only go to zero. And by the way, these funny icons here, they mean something. I will tell you later on, okay? If that wasn't bad enough, markets usually tend to go to the upside, right? That's because of inflation and monetary supply. So if you are shorting for longer than you should, then you're swimming against the tide, because the tide is to the upside, right? Not to the downside. So you're basically fighting the usual trend and nature of markets. If you look at S&P 500, or if you look at the NASDAQ and so on, you see that it goes up. And this is Bitcoin. It also goes up over time. That is why long term, it makes sense to be long, right? And short term, it could make sense to be short, but the probabilities diminish, which is why you need to be very accurate when shorting. So that is another thing that you need to keep in mind. When going long, you don't have this risk. It's not there, right? Okay, so this is another thing, unlimited loss, all right? The next curtain is showing the liquidation risk. Liquidation risk is something that, well, you need to understand that you basically, whenever you're shorting, okay, then you have an account with some assets on them, right? On that account. So you have, let's say, some dollars, like USDT, USDC, you have some Ethereum, you have some Solana, and then you suddenly decide that you want to short Bitcoin. You're actually borrowing this Bitcoin, right, from the exchange, and the exchange wants it back at some point, right? And the total amount of the time that you borrow it per hour, right? Remember that you have the hourly rate, okay? You pay fees for that, okay? And if the debt, right, becomes too large and this costs you more because it goes in the wrong direction, no? Like it goes up instead of down, then at some point it's bigger than your value of the account, and then you lose the whole account, right? They take everything, right? At some point, they take as much as they need to cover the amount you borrowed plus the fees that have accrued until then. And that's also why the liquidation level comes closer and closer to you the longer the short is open, because the fees accrue, right? And so the level comes closer, right? Of course, it's not super fast, but it happens, right? So this is something that you need to keep in mind. And this is something that people don't understand, right? So you're actually borrowing the asset so that you can go short in the first place, okay? When you go long, you don't have this situation, right? Because you don't borrow anything. You don't have any debt, right? But when you go 1x short, you do have debt, right? Suddenly you owe somebody something, which is the asset that you went short with, right? So you owe the exchange the Bitcoin, right? When I go long with Bitcoin 1x, I have the Bitcoin, I don't own anybody or something, right? So this is very important. So 1x long is safe, so to speak, and 1x short is already borrowing assets, right? You owe somebody money, right? And of course, if I go 2x, then suddenly the long also is borrowed, like is leveraged, right? That's a different topic, right? But that's a topic for another video. But just to understand that going short is not exactly the opposite of going long, because in the short situation, you owe money, okay? It's not the same thing. If you owe money, you have a third party that is suddenly interested, which is the exchange, is interested in what is happening there and is interested in taking your money, right? If it goes against you. So that is important, right? Where in this case, there is no third party interested in anything. It's your own problem, right? If it goes in the wrong direction, and that's it, right? So this is hugely important. You need to fully visualize this, right? And that's why we have this awesome diagram. By the way, it took me like whole day to make this diagram for you guys, okay? Okay, let's go to the next risk, which is hidden behind this amazing curtain. So where are we now? Liquidation risk, okay? So liquidation risk is basically the risk. Oh no, sorry, that's I just undo it and then it came back. Okay, so we have the next curtain. The curtain here is that you can have something called a short squeeze, okay? And before I explain what this is, let me play you this video so that you hear it from the horse's mouth and you see what happens to very large investors.
When I was at Soros, I shorted $200 million worth of internet stocks in March of '99, and in 3 weeks covered them at a $600 million loss. I lost $600 million on a $200 million investment in 3 weeks. I was short 12 stocks. They all went bankrupt, every one of them.
So what he basically saying is that he was correct to short them, but he shorted them at the wrong time, okay? So the market first went against him, right? So he had to cover and he had to buy. Basically, he got squeezed, right? So the liquidation level or the price came very close to the liquidation level. He didn't want to lose all of his accounts, so he had to buy back the borrowed assets and give them back to whoever he borrowed it from, usually the exchange, so that he doesn't get liquidated, right? So that creates buy pressure, right? Because you need to go and buy it on the freaking market, right? So let me show you that again with the chart. And so that means if it goes against you, right, then you have to, so let's say you shorted here, right? And you don't want to get liquidated, then you can add more money to the account as collateral. But also at some point, if you don't want to keep the trade open and you say, screw that, I want to just get out of this, you have to buy, right? Or here, whenever you want to close it, you have to buy the asset to return it to the exchange, right? Because the exchange wants it back. And when you buy the asset to return it to the exchange, you are creating buy pressure, right? And that's what pushes the price to the upside. And that's what basically is a short squeeze. So this could have been actually a short, I think this could have been because it's so violent, right? So fast. And so then people have to cover and they have to buy and give it back. And that is called a short squeeze, right? And it's called a short squeeze because the shorts get into a corner and they get squeezed and they have to give up, right, their positions. And if you don't know what the liquidation level is, I have a link here. I will put it down in the comments, or not in the comments, in the description. So for Bitcoin, for example, right now, we do have a liquidation level actually here at 86,360, right? That means that people who are short, right, they will get liquidated when and if the Bitcoin price goes here. So yellow means there's a lot of liquidity that people getting liquidated if the price goes there. And usually the price goes a bit above that and then does whatever they want to do next, right? So this could be a short squeeze when the Bitcoin price, which is right now here, it goes up, then they have to cover and price goes higher a bit than that, right? Because of the short squeeze. And that's why it often overshoots, right? So for example, here, it didn't go exactly here, it went a bit above, right? Because of that. And it's often the case. So these are liquidation levels. Again, I will put the link to this page down in the video description. You can then choose the asset that you want to see the liquidation levels for. You can choose the time frame, all these things. I use Model 2, by the way, you can decide. And so this is another risk that you need to keep in mind. Now, does this risk also exist for longing? Well, no, right? Because like I told you, if I do the wrong thing and let's say I buy here and the price goes against me and I have to wait like 4 years for it to recover, it doesn't matter, right? Because I don't owe anyone anything. So nobody will come after me, right? And say, hey, where's my asset, right? So you don't have this risk, which is why it's not here on this side whatsoever. Okay, so this is a risk only for shorting, and this is for 1x shorting. Again, if you go leverage, you have most of these risks also on the long side, okay? And just to clarify, when I say 1x long, it means there is no leverage involved, right? But when I say 1x short, there is already leverage, because shorting doesn't work without leverage. You have to borrow the asset, right? And that is what adds additional risk. That is what adds the whole risk, basically, because you wouldn't have any of the liquidation, any of the short squeeze, any of that if you wouldn't borrow, right? So when you start leveraging the long side, 2x, 3x, 4x, 10x, then you have all the same risks, right? But going long with the money that you own would not add these risks, but going short with the money that you own, not more, just the same amount, already adds all of those risks, okay? That's important to remember, right? So now you learn, right? Now you know how this works. Okay, we have the next curtain over here. What is behind this one? Let's check it out. Okay, it amplifies emotions. Well, this one is one that, well, I have to explain to you like this. Imagine you are in a short position and you owe this asset back to the exchange, right? And you have the liquidation level above your head, right? And you hope and pray to God that it's not gonna hit, right? But let's say the price goes against you and your emotions are piling up, right? Because you know you will get liquidated, because you know that this is a risk, and it's not easy to make the right decision in this context, right? In this stressful moment where should I put more money or should I close it, or oh my God, you know? So this is a risk, or like an emotional risk, that you do not have when going long, okay, on the spot account, right? So you don't have this, and so that it means that when you're going long and it goes in the wrong direction, the worst thing that can happen, which is pretty bad also, but is that you have a lot of loss of purchasing power, but then hopefully it will recover, right? By the way, I have a video about that, which I will put over here, why buy and hold and DCA are horrific strategies for crypto assets, right? Don't judge me yet, just watch it and then you will understand. So you have more emotions that are involved, and when emotions are involved, usually profits are not made, right? Money is usually lost. Emotions are a problem when it comes to trading and investing, because instead of making the mathematically correct decision, people make the emotional decision, especially when they put more money than they can afford to lose. Then they might actually close out the short, and then it goes in the right direction afterwards, right? So again, let's go to the chart, because Bitcoin has done all of this already, okay? So let's say that you go short over here, right? Or whatever, here you go short, boom, short squeeze. You're like, oh my God, I have to close and lose. And okay, I want to close the position because it's money I cannot afford to lose. What if Bitcoin now goes to 100,000? Because people were actually saying that here, right? This is the double top and so on, right? So you close it, but then you were correct, right? It's just that you needed to wait a bit longer. But because emotions are involved, it's very hard to make the right decision, okay? Because again, you have the fees, you have the liquidation, oh my God, right? So emotions are a huge problem, right? So emotions also exist on the long side, don't get me wrong, but they're way more amplified on the short side because of all of the risks that you are now aware of, right? And they will hunt you in the brain, okay? It's very tough. And by the way, down here we have the solution for all of these risks, okay? So stick around, I mean, you will learn a lot of stuff. The last curtain reveals that when the exchange goes bankrupt, you lose your money. Why is this a problem here? And also on the long side, the same risk, okay? Why is that a risk? And why is it specifically problematic for going short? Well, because you tell me, when exchanges go bankrupt, do they go bankrupt in the bull market, or do they go bankrupt in the bear market? Okay, you tell me that, and then we can talk about why this risk is even riskier when shorting than when going long, right? So let me show you, right? So this is why we have the funny icons over here, right? So we had an exchange going bankrupt over here. This is Mt. Gox, right? So if you're shorting here, right, and if you're on Mt. Gox, you might be correct, but you lose all of your money. Who cares, like, that you were correct? You were on the wrong exchange. Oops, right? That's a bit of an issue. If you are long, right? If you're long and you see that it's going down the drain, you can take your money, you can put it on a wallet, right? And you can just wait it out. But because you are short, you are on the freaking exchange, right? So if the exchange has a problem while you are short because you are locked into that exchange, well, then you are in big trouble, right? Because you might have been correct, but then you're never going to get your money, right? So that's another risk that you need to keep in mind, okay? So you can put your funds on a wallet when going long because you just hold it and that's it. But when going short, you cannot take the funds and put it on a wallet because you're short, right? You are on the exchange and you will stay on the exchange until you close the position, okay? Again, emotions where you can actually make the wrong move, okay? So this is very important. Then we had another exchange that went bankrupt. I forgot the name. Actually, I will put it here on the screen later on. And then also we had FTX, right? So even if you shorted and you made a lot of money and you were on FTX, your money is gone, mate. Like there is nothing you can do about it. So there's an additional risk, right? And that's why I want to tell you, and you should remember this, right? Going long is for the long term, okay? So you can go long and you can just hold on to it for forever, really, and you have no costs. And whenever you are unsure about what's going on in the market, you just take your funds and you put them on a wallet and you wait it out. Okay, so that is cool. But shorting is for the short term, right? Because of all of the stuff that you have learned above, right? Because you have all the fees, you have the liquidation risk, you have the short squeeze risk, you have unlimited loss risk. So you cannot keep the short open for a long time. It doesn't make sense, right? So when you are thinking about shorting, then you are automatically thinking short term, right? You have to, right? That's the whole thing. So if you are a person, and let me do it like this because it's very important, right? So if you're a person who wants to invest for the long term and you care about the long term, then shorting doesn't fit the narrative. It's the wrong thing to do. It will mess your brain up, okay? You will basically just do things that you shouldn't do for the person who you are. Right? So if you care about the short term and you do want to look at the charts and you know move the liquidation levels up and all these things, then shorting might be for you, right? So keep in mind that shorting is for the short term. So you cannot keep a short open, and because this looks so sexy, right? Oh, if I shorted here and I bought back here. Yeah, but this is like 2 years, mate. Like this would be so expensive and you're taking massive risk of the exchange going bankrupt. You won't do that, okay? Like it's not smart. So this is something that people don't know, but that's why I'm making this video, right? So now you have seen all of the risks that happen when shorting 1x, and you can see that longing is less risky. It's like, it's very obvious, right? So now that you know all of this, right? And you know that it's, you know what the game is, right? And what the risks are. Now let's talk about the potential solutions, right? The potential solutions for all of these risks and how you can mitigate them. You cannot fully eliminate, right? Because you still borrow funds and you need to pay them back and all these things, but you can try to mitigate it, right? So let's see how we can do that. For that, let's go down here to our massive curtain, which basically reveals all of the solutions. And I want to just remove it all at once and go through this with you. So short only with 25% of the long trade that you would have made. Okay, so just put less money, okay? Because it's riskier, you have to reduce the funds that you put in. It's pretty obvious, right? So when you have higher risk, what you can do is either hedge against it, but that's a different video, or you put less money, right? So put less money in this case, right? And also understand the game. So you basically have understood the game by watching this video. So now you know what are you getting into, okay? You know the lion looks like this and it's risky and it will eat you like this, okay? So now you can take precautions, all right? The next thing is that you need to remember to short for a short amount of time, which I just told you before. So just keep that in mind, okay? Don't think that you can keep the short open for like months. It's not a good idea. And whoever did that already, please comment down below and tell me the fees and the emotions that you had to go through, okay? Just let me know, all right? Okay, cool. And then take profits aggressively, right? You have to be like a machine taking hardcore profits, right? Because the thing is that you don't have so many short opportunities, and also it's for the short term, right? So if you are lucky to make money, right, you short from here to here, just take the money and run, okay? Don't, you know, keep it open or be greedy, or maybe it makes more profits, right? So just take the profits and run. So whenever you're lucky to make such a short here, boom, take it, go away, be happy, right? Don't try to force your luck, because remember, most people, even on the stock market, they should know better. They lose money when shorting, okay? So you need to know all of this, and now you know, right? So with all of this in mind, okay, let me know down in the comments if you now fully understand what shorting is, if you still want to short, right? And what kind of mindset you have. Do you have a long-term mindset, or you have a short-term mindset. And if you know me, then you already know what type of person I am. And let me show you on the chart why I am such type of person, right? So this is the Gaussian channel strategy, and I use it as an example for what I want to say next, right? So by the way, this strategy is pretty good, to be honest. I ran the numbers on many assets, compared it with a lot of other strategies, and it's still the best one, or one of the best on the top there from the freely available strategies, right? But anyway, so look at this, right? So it made in long only, right? Long only, it made 2,500% profit, okay, with 30% max drawdown. Okay, this is not financial advice, right? It's just an example to show you what is possible. Now, if it would have shorted, right? If it went short, it would have made a little bit more money. The drawdown is higher, right? And I have all of the risks that we talked about here. So yes, I make a little bit more money, not huge amount of money, right? But I take all of these risks and I have to basically eliminate my emotions and all these things. So the question is, am I greedy? So I'm always asking myself this question when I want to improve and squeeze more funds out, like more profits out, right? The question is, am I greedy, or what is the reason why I'm thinking like that, right? Can I make more money, right? So whenever I ask myself if I can make more money, it's very often that I'm greedy and I'm not patient, right? It's very often the case. So if you're not happy with 2,500% profit on Bitcoin, and by the way, just for fun, let me show you Solana, right? 18,000% profit on Solana, or let me show you also FetchAI just for fun also. FetchAI 8,000% on FetchAI, even though the chart is horrific, by the way. Yeah, the drawdown is higher and whatever. But so like, if you're not happy with that, then the question is, what is wrong with you, right? Do you want to take more risk? For what reason? Okay. Like, do you want to, is the risk reward ratio still good enough, right? Is it good enough? And if you think about what happened in the crypto history, where exchanges went bankrupt and people got liquidated and they lost all of their money, right? Then you have to really ask yourself, right, the main question: are you here for the long term or are you here for the short term? And unfortunately, if you are here for the short term, then there is a higher chance of you not making it, because the market is skewed like that. Okay, if you're here for the short term, you must take more risk, and if you do that, you can end up getting screwed, okay? And if you're here for the long term, you can take less risk so you can survive it longer. Makes sense, right? And this is what this diagram also shows you very nicely, right? It shows you that you take way more risk when you short than when you go long, right? It can work out, but if it doesn't work out, you lose all of your money, right? In the long case, you cannot really lose all of your money unless you leverage, which is not part of this video, okay? So you understand now that you need to really write it down on a paper. I'm here for the long term, because then I have higher chances of making it, right? And if you're here for the short term, well, then you need to watch way more of my videos, because you need to be very much educated, right? To actually eliminate this risk as best as possible. But you also need a good trading strategy, right? That actually keeps you from making these mistakes, because it's automatic, right? So let me remind you that I'm building, or I'm advocating also, but I'm building a software called SIGNUM. Let me go there now. SIGNUM is for trade automation, and I will put a video after this video which explains how to take a trading strategy and fully automate it on your exchange, right? You can click the buttons, very simple. The video explains everything, and then you can have everything fully automatic. Yes, I don't have a strategy that goes short, but I will have, and that's the surprise that I was talking about in the beginning. So let me show you right now. What you see in front of you is the Gaussian channel V4 strategy, which has shorting implemented into it. And I will launch it very soon, not now, not with this video. There will be another video, so make sure to subscribe. And basically you can see the numbers. It makes more profit. It also has 10% points, 11% points even more drawdown. Okay, so the risk is higher, the reward is higher. That makes sense. Also, it has more trades, obviously, because it's investing more often, right? It goes short as well. And so here, basically, you will have a checkbox for allowing short and not allowing short, right? And you'll be able to use both. And fun fact, and I'm not going to explain it in this video, but just fun fact, the shorting strategy actually loses money when shorting overall, okay? So overall, until today, it actually loses money when shorting. But how can it still make more money in total? Well, I will explain to you all of that when I do the video about this particular strategy. Okay, so make sure to subscribe, make sure to like, click the bell, all of these things. Also, join the Telegram group because we're helping people there, right? About all the questions they have about trading strategies, automation and risk management, all these things. I'm still not gonna short, okay? This is not my business. I have way too much money invested in crypto for that. And I would like to be able to take it off the exchange and put it on a wallet whenever I feel like it makes sense. When shorting, I cannot do that. That's why this is not for me. If you wanna do it, increase your risk, but also increase your reward, fine. You can do that. And for whoever is still here and actually already knows SIGNUM, SIGNUM is not yet capable of shorting, but we are launching that very soon. Okay, we're gonna launch that in like a week or so with Hyperliquid. So you can not only short, you can also short on chain, which is very interesting, right? Because that adds a bit of a different twist to it. So you are on the chain, on your wallet, but then still short. So that kind of mitigates one of the big risks I was talking before, right? So that's very cool. Of course, we're gonna add shorting as well for Binance, Bybit, and all the big guys as well. You can do that as well, okay? So that is something that is coming. And with all of that in mind, we also have one more thing that you can do to mitigate your risk, which is to get educated, right? So this is my one and only AutoTrading Masterclass, where I teach you everything you need to know about automation. I tell you everything about risk management. This is for people who have a larger portfolio, like $25,000 or more, usually more, right? And please check out also the ratings. But basically, you get access to my personal strategies, you get access to all of my knowledge and to all of my risk mitigation tactics, all of my templates. So if you want to join the course, then, well, you have to get accepted and all these things. So you have to click on apply for access, and then you book a call, and then we're going to talk and we're going to figure it out, right? This course is not for everybody. It even says on the website, okay? And the reason is that after a lot of years of trading and investing, I understood one thing, and I will make another video about this, but one thing that is super important, changed everything for me, which is that the most important thing is risk management, not making money, okay? And most people don't yet understand this, okay? So if you understand that risk management is the most important thing, then you will make a lot of money. But if you come and say, hey, I want to make the most profits, I don't care about the risk, then this is not for you. Okay, you can just use the free strategies I have online. You can use SIGNUM and have fun. Okay, but if you have more money, okay, at least 25,000, which is not a lot of money. Okay, most people in the course, they have hundreds of thousands, millions even invested using this system. They understand that risk management is the most important thing, and that's why they are successful, right? So just keep in mind, okay, so this is not for everybody. I'm just putting it out there because I want to attract the right people, because I want to build the best community on this planet when it comes to, long-term investing in automation. But I want to attract the right people. That's why I'm telling you this, okay? Maybe it's for you, maybe not, right? And that's why we have the application process, so that we can talk to each other and understand what your goals are, what the course goals are, if we like each other. So this is not like I want everybody to join. No, okay, I want the right people to join, and that is why the process has a couple of steps, okay, because I care about quality, right? So, okay, keep that in mind. We already have huge amount of members anyway, but I would like to have more members, up to 1,000 members. We are limited to 1,000 members, right, into this course. So if this is for you, then apply. With all of that in mind, I hope now you understand that shorting is way riskier than longing. It's not just simply the opposite of going long, because you borrow the asset, okay? So you have a third party that has an interest that you have to pay, right? And an interest to liquidate you if you don't pay, right? And if the price goes against you, which you don't have when going long. So keep that in mind, okay? And with all of that, you can play the game, but now you know what the game is, okay? You know that you can get short squeezed, you can get liquidated, you understand you cannot take your funds off the exchange while shorting, and all of these things, right? So please keep all of this in mind. And whenever somebody tells you, hey, shorting is just the opposite of longing and is why not shorting, then at least watch this video and then go and use the knowledge to your advantage, right? And so make sure to subscribe, come to the Telegram. We're going to launch this strategy for shorting as well, together with the SIGNUM feature for shorting, so you can automate it, right? The whole point of my channel is to automate, right? So that's all I have for you. And if you care about this particular Gaussian channel strategy, or you care about automation in general, then this is the next video you should watch.
AutoTrading